Imagine this. Headlines tout record high stock markets and historic valuations, while ordinary people struggle with layoffs, weak wage growth, and real economic pain. It sounds like a contradiction, but it isn't a mistake. What we're witnessing today isn't just a market rally or normal economic cycle. It's a financial illusion, a disconnect between Wall Street and Main Street, where the value of stocks continues rising even as the broader economy shows persistent weaknesses. But how can markets soar when the economy feels like it's collapsing? And what does this illusion really mean for you and the future of finance? Let's break it down. The market isn't the economy. It's a reflection of profits, not jobs. First, a crucial truth that many people overlook. The stock market is not the economy. The stock market measures the profits and expected future earnings of large publicly traded companies, not the everyday economic experience of workers, small businesses, or average families. When most people talk about a strong economy, they might think of job security, rising wages, affordable housing, and healthy consumer spending. But the stock market doesn't measure those things. It measures corporate earnings, investment flows, and investor expectations about the future, which can diverge wildly from what most people actually experience. That's why you can read headlines like S&P 500 at record highs, even when job growth is sluggish and real incomes aren't keeping pace. Superstar companies driving the market higher. Another major reason for the sharp disconnect is market concentration. In recent years, a handful of mega-cap companies, often called superstars, have come to dominate broad stock indexes like the S&P 500. These companies, heavily weighted in tech and AI sectors, are massively profitable and power the headline numbers, even when the broader economy is struggling. So, when investors cheer, "The market is up," they're often referring to big tech giants that are highly profitable and expected to grow, despite weaker consumer demand in the real economy. The broader business landscape, small businesses, manufacturing, and service industries can simultaneously be struggling or stagnating, while the headline market keeps rising. That's why the stock market can signal strength, even when the majority of the economy feels weak. Liquidity, central banks, and the illusion of growth. One of the biggest forces behind the market's seemingly unrealistic highs is massive liquidity from central banks. Over the past decade, governments and central banks around the world have flooded markets with cash to support economic stability through quantitative easing, low interest rates, and policy support. This liquidity didn't only help the real economy. Much of it flowed directly into financial markets, driving up asset prices independently of economic fundamentals. Corporations use cheap capital to buy back shares, which mechanically boosts stock prices. Large investors borrowed cheaply to buy more equities, and hedge funds piled into risk assets, all pushing prices higher. In this environment, markets become less about real productivity or economic health and more about the availability of cheap money. When money is easy and yields on safer assets like bonds are low, investors hunt for return wherever they can find it, often in stocks, and especially in big tech stocks. The result? A market that looks strong, but one whose strength is rooted in monetary stimulus rather than underlying economic growth. Wealth inequality and the asset inflation effect. Another key part of the financial illusion is who actually owns the market. Stock ownership is highly concentrated at the top. The wealthiest households own the majority of equities. That means market gains don't translate into broad-based economic prosperity. The average person relies on wages, small savings, and consumer purchasing power. When jobs are weak, incomes stagnate, and prices rise, people feel economic struggle, even as stock portfolios owned by the wealthy surge in value. This creates a situation where the perception of economic success, based on stock indices, diverges completely from economic realities for most people. It feels like the system is rigged, because in many ways it functions that way. This divergence between real economic experience and financial asset performance is one of the core reasons why the market can be high, while the economy feels low. Earnings expectations versus current consumer reality. Stock prices don't simply reflect today's economy, they reflect expected future profits. Investors often price in what they think corporate earnings will be months or even years from now. That's why a tech giant can have a sky-high valuation, even if inflation erodes consumer spending power or wage growth lags. The market is effectively betting that, in the future, earnings will grow enough to justify today's prices. This disconnect becomes especially pronounced in times of uncertainty or change, like now, because markets are responding to projected technological growth, AI advancements, and long-term global demand, rather than short-term GDP figures or weekly jobless claims. That's part of why high markets can coexist with slower real-world economic activity. The illusion creates risks, not stability. The danger of this financial illusion is that it hides fragility. When markets are driven by liquidity injections, concentration in superstar companies, and future-oriented earnings expectations, rather than robust economic health, it creates systemic vulnerabilities. Investors might feel confident because they see numbers rising on a chart, but those numbers can be detached from reality. When markets paint a picture that isn't rooted in broad economic fundamentals, it increases the risk of corrections, volatility, and sudden reevaluations, especially if central bank policies shift or liquidity contracts. Why this great illusion happens? At its core, this disconnect, this great financial illusion, stems from a few powerful forces: monetary policy and liquidity floods. Central bank supports pushed money into assets instead of wages. Superstar concentration. A small group of mega-cap firms dominates market performance. Investor expectations. Markets price expected future earnings, not current economic hardship. Wealth inequality. Gains are felt most by the wealthy who own the majority of financial assets. Financial engineering. Buybacks, derivatives, ETFs, and quantitative strategies inflate asset prices even further. Together, these create a scenario where markets can be high, even when the economy looks weak on Main Street. Markets powered by liquidity, not economic strength. A major reason markets can stay high, even when the broader economy is weak, is liquidity, not economic health. Central banks around the world, especially the US Federal Reserve, have used stimulus tools like bond purchases and near-zero interest rates to drive asset prices higher. When central banks flood markets with liquidity, investors have fewer attractive safe options, so money flows into equities, bonds, and risk assets regardless of underlying economic conditions. Even when jobs slow and wages stagnate, cheap money pushes financial assets up because investors are basically priced out of low-yield alternatives. This dynamic has been visible in the latest policy cycle, where the Fed paused rate cuts due to inflationary pressure and geopolitical risks. Yet markets still cling to the expectation of future monetary accommodation. Investors are effectively betting on continued support, not real economic growth. The AI narrative and sector concentration. Another explanation for the illusion has nothing to do with GDP or wages, and everything to do with a narrative theme: artificial intelligence. In 2025 and into 2026, AI-related sectors, particularly technology and cloud computing, have consistently drawn capital. Even when broad economic indicators weaken, investors still funnel money into companies with strong AI narratives or growth stories. This effect helps keep major indexes afloat, even as most other sectors struggle. That concentration means the stock market's headline figures can remain high simply because a handful of mega-cap firms, often AI-linked, are outperforming. In reality, most other equities and industries aren't booming alongside them, reinforcing the illusion that the entire economy is strong when only parts of it are. Geopolitical and macro risks masked by market behavior. If markets were fully rational, they would respond to real economy stressors, inflation, geopolitical shocks, higher oil prices, reduced consumer spending, in a predictable downturn. But in 2026, markets show the opposite pattern, sometimes rising even as risk increases. For example, ongoing geopolitical tensions, especially the extended conflict involving Iran and impacts on global oil supply, should push equities lower because of higher inflation and economic disruption. While some market segments have fallen in response, major indexes have demonstrated resilience or rebounds driven by liquidity and future expectations rather than current economic fundamentals. This illustrates a key point. Markets often respond more to what investors expect next rather than what's happening right now. So even if global growth slows, inflation remains high, and consumer sentiment is weak, markets can climb because they're pricing in future scenarios, like Fed rate cuts, technological advances, or corporate earnings rebounds. Consumer sentiment versus market sentiment. Another source of the disconnect is consumer sentiment versus market sentiment. Even when GDP figures look okay, surveys show consumers feeling pessimistic about their financial future. Recent data reveals a sharp slump in consumer confidence, with concerns about inflation, income, and job prospects. far outstripping the optimism reflected in market indexes. This clash, weak confidence alongside rising stock indexes, is exactly what economists describe as structural divergence. Put simply, millions of everyday households feel economic stress, while market prices reflect the views of investors with capital to invest. This bifurcation creates an illusion of prosperity that few actually experience. What this means for you? For investors and viewers alike, understanding this illusion matters. Recognize that market highs aren't a guarantee of economic prosperity. Understand that liquidity and expectations can keep stocks elevated even during economic stress. Realize that wealth gains in markets don't necessarily translate to broad economic health. Prepare for volatility and potential rebalancing when markets and realities reconverge. Being informed doesn't mean panic. It means anticipating different scenarios and making smarter decisions. The great financial illusion: the stock market and the economy aren't the same thing. And in 2026, that difference is clearer than ever. What looks like prosperity to market timers may feel like strain to ordinary workers. What looks like strength in stock prices may be liquidity effects, narrative themes, or forward-looking forecasts, not economic reality. This is the great financial illusion. A world in which markets and Main Street tell completely different stories. If this video opened your eyes, hit like, subscribe, and comment below. Do you think the market will eventually reflect the real economy? Or is this divergence the new normal? Share this video with friends and family, so more people understand not just what markets are doing, but why it matters to their financial future. Because in the end, the market's rise doesn't mean the economy is healthy, it just means the illusion is powerful.